Hello, this is Ilan Awerbuch, and this is Mortgage Watch for February 25th. We're in the middle of our four-part series, Our Big Banks Bad, and this is part 3. We'll talk about how the big banks and Wall Street firms tweaked with standard loan guidelines to bring you more of the mortgage crisis. Well, last week's blog, we talked about the history of subprime lending and how the Wall Street firms took what was really an effective product for many people and had performed for many years and tweaked it to create this giant subprime debacle. Today we're going to look at how they did something very similar with prime loans. After seeing the huge profits that could be earned from subprime and the way that they were able to package it up, what I call the too big to fail banks and their fallen brethren, the companies that weren't allowed to succeed, that is Bear Stearns, Lehman Brothers, Countrywide, Merrill Lynch, IndyMac, and WAMU, they looked for ways to make the same type of huge profits on loans being made to more standard borrowers. Among the more obscene things they did was to really push out NegAm loans. Now, negative amortized loans have been around for a long time and used quite successfully, but their traditional use was very different than what Wall Street came up with. NegAm loans, or negatively amortized loans, are loans where the interest rate and the actual payment rate are very different. And they confused many borrowers. They confused many loan officers. But everyone figured out how to make money on it on the lending side, and many borrowers refused to ask the right questions. Basically, you have a start rate, and it may be as low as 1%, but the actual interest rate of the loan is much higher, 4 or 5%. You're allowed to make payments at 1%, but the part that you're not paying is being added back onto the loan balance. Hence, it's called a negatively amortized loan because your loan balance is growing. For many years, these were made to high net worth individuals, people with excellent credit, and especially with people with low loan to values. That is, they had a lot of equity in their home. So if their loan ended up growing a little bit, that was okay. They had plenty of equity in their home. Well, the Wall Street firms started tweaking with the standard NegAm schedule to come up with a way that was more successful for them to make money at. The first thing that they mess with is loan to value. So whereas NegAm loans were typically made at a max of 75%, they started increasing the loan to value to 90% and in some cases to 100%. Well, it doesn't take a genius to figure out that at 90 and especially at 100%, if the person is not making the full payment due and it's being added on to the loan, they soon will have no equity or soon will have negative equity. Well, that's what's been happening. And that's one reason that NegAm loans are in so much trouble as a pool. The other thing that happened was they started tweaking with borrower credit scores. In the past, only the best credit borrowers were allowed to apply for and get NegAm loans. But in the Wall Street world of things, suddenly it became okay for borrowers with marginal credit to get NegAm loans. These are people who by their history have not managed credit that well, and yet they were given the right to get negatively amortized loans. In many cases, borrowers came to me and said, hey, I just got an offer at a 1% loan. These were sometimes people who were pretty smart, and I wondered if they really were looking at stuff or wondering if things were too good to be true. Well, a lot of homeowners didn't really ask the right questions. A lot of seniors, a lot of people were just sold into this thing, but honestly didn't really ask any questions or wonder how it was that their interest rate might be 1%. As I've explained to you, the true interest rate is really 4, 5, 6%, and that's the problem with NegAm loans. Well, the current picture of NegAm loans is this: growing balances from borrowers who made the minimum payment so that their loan balances grew, combined with falling home prices. As home values went down and the loan balances went up, more and more NegAm borrowers discovered that they have no equity, or worse, that they have negative equity. Another factor of NegAm loans is the reset. That is, if the loan grows to a certain percentage too large, the lender has the right to reset the payment. So as the loan balances grew past 110%, they were reset. So the borrower who thought they were going to get a very small payment actually was getting a very large payment, because suddenly that loan had to be paid off in 25 years' time or less, making for a very large payment. We have a huge amount of NegAm loans that are starting to reset beginning this year. So it's a problem that hasn't really come to the fore yet. It will be starting this year and grow into the future. Like subprime, a product that has its proper place and time was misused. You know, gasoline does a really great job of running our cars, but it's not really good near an open flame. The too big to fail banks and their fallen brethren, well, they put subprime and NegAm loans way too close to the fire, and that's why they failed. Not because they're not good loans for the right borrower, but they have to be used in the right place and context. Most importantly, loan to value. If you give someone no equity or negative equity, you take away a lot of their motivation to make payments. Well, I've kind of talked a lot about NegAm loans, but I feel it's something that's very important for all of you to know. As I said, there's a lot of resets coming up this year, and it'll be continuing for the next 3 to 4 years. Hopefully, the regulators and the government are coming up with some plan that will help to force banks to keep these resets from happening, or else the foreclosure trend is going to very much grow over the next several years. Next week, I'll talk about the current sorry state of residential lending. For some of you who have applied for loans recently, discovered very, very hard to get a loan these days. Best credit borrowers, low loan to value, excellent job history and income, still no longer guarantees that you're going to get a loan in any kind of sense of time, less than 45 or 60 days. I'll discuss that in more detail next week when we look at the current sorry state of residential mortgage lending. That's it for now. I'm Ilan Awerbuch at the Unit Trust Companies in San Diego, and this is Mortgage Watch. Thank you for joining us.